Hello, my name is Selena Ceballos. This is Tori Seipert. I am a supervisor for the Client Accounting and Advisory Services at RNA CPAs. So I do the back end accounting that you would think of, kind of like bookkeeping, but plus more. And so we've dealt a lot with what you should be looking out for, what you should do towards the end of the year, and just things to keep in mind as the year starts to close and you guys begin to grow as a company. And then Tori's going to go over the tax portion of these things, where what you should be considering, such as like your R&D credits as you guys begin to expand and bring in grants and so on and so forth.
Yeah, I mean, that was a great introduction. I am a manager here at RNA CPAs, been here for about 5, almost 6 years now, and I'm in direct contact with Adam Ford, who you guys have seen before, almost daily. So, without further ado, let's get on to the agenda.
Yeah, looks good. So for the accounting portion of this, I'm going to cover some bank reconciliations, like catching up to year-end activity that you should look out for, large and new purchases, things that we should probably be looking out to depreciate, that will give you some worth and equity and all of that into your business. W-2s, what should be included in a W-2, and 1099s, who should receive a 1099 and why you should be issuing one. Then Tori will go over tax,
which is just basically a couple of tax strategies to save you some money, hopefully, including depreciation, the R&D credit, QBI, which you guys may have heard of before, and then something that's relatively new is the pass-through entity tax.
Sounds good. So the first thing I would like to cover is bank reconciliations. A lot of times when we see accounting come through, especially with newer businesses, you guys are always focused on getting the business going, transactions moving, and bank reconciliations can be a great help with that, because you are using your bank reconciliations to compare what you have spent as your transactional activity for the business, your operating activity, towards what's been clearing in the bank. So part of that is entering all of your operating transactions and monetary activity. Some of these things that we've seen that sometimes get looked over and don't get included are cash purchases. So if you were to receive, somebody made an investment and you withdrew cash, we're going to record it as an expense, but we need to know what exactly that was, used to purchase. What did you buy with that cash, so we can then categorize it correctly, especially as most of you are receiving some grants or some funding where you need to track all of those expenses. So it's good to make sure that we categorize those correctly. And contributions are another one that I've seen that gets looked over sometimes, especially when it comes to small startup businesses like yourselves, where like you as the owners are then putting money into the company, and sometimes personally purchased items don't get included in your overall bookkeeping. And so we want to make sure that we can include all of those in your bookkeeping, so you receive that credit for your capital and your equity, and that there is a record of how much money went into the startup company. And so we want to make sure that all activity and transactions are entered, whether they're monetary, tangible property, and that your bank is reconciled, so we know if there's any outstanding transactions that we might want to look at. This is a good place where we also catch some fraudulent activity. So it's always trying to be good about keeping up with reconciling your accounts, especially as we get to the year end. That'll be helpful once you get to tax preparing. Next thing I want to cover is new and large purchases. So this is also an area where we want to keep an eye out for, because as the company grows and you guys start to expand, you're doing some research, you're buying equipment, you need to, furnish a business building, you need your office. So some of these purchases that you're going to be making are going to be depreciable. So that's going to give them a useful life of operating through your business at a standard that is set by the IRS. And so we break down those expenses and we give them to you over time, so you don't take them all as a lump sum up front. And those can include equipment, vehicles, office furniture. So if you buy computers, you need to work on computers, your employees need to work on computers. If you bought a building to work in, all of these things need to be capitalized, as we call them, and they're considered a fixed asset. And so we want to make sure that those get categorized correctly as well. And that also brings in your large purchases. So if you have a vehicle, you're driving around and you need to make a very large repair to this vehicle, if it's worth over a certain percentage that you can cover with whoever is doing your taxes or doing your accounting, those repairs can also be depreciable, and bulk purchases of office furniture, building improvements that you made, maybe you needed to add a lab to the building you're renting, all of those can be included as a fixed asset for your business as you move forward. Your W-2s and bonuses. So this is also one that it's good to stay aware of as you're moving and you're paying employees, contractors, so on and so forth. So on a W-2 is issued to an employee who has been contracted by your business, and on your W-2, you report wages. What's important to keep on this is that sometimes, especially as we get to the end of the year, the holidays start to roll around. Owners like to hand out bonuses to themselves, to their employees, and then sometimes they get missed and don't get included on your W-2s. These should be included on your W-2s, so they are included as taxable wages. Any medical insurance that is being paid by the company for you as the owner needs to be also reported on your W-2. And so just to clarify, that is medical insurance paid for the owner. Those are considered wages as well. And then you want to make sure that you disclose any retirement contributions that were made, and those will have their specified boxes as you're filling out your W-2. So your W-2s will also include how much taxes were withheld and remitted for the employee to the IRS and to the state, including federal income tax, Social Security, Medicare, and state income. And so another thing I wanted to point out before we move forward to the last accounting slide is that reimbursable expenses, such as if you have a employee who you contracted and lives out in Idaho and you're like, you know what, I need you to work in Arizona, I will pay for the expenses of you moving out here to work for me. Those are now going to be taxable wages for the employee. Although you are paying them, it's part of their contract to move down here, those are considered taxable wages, and so they do need to be included on their W-2, as well as home office equipment. So if you have a remote employee that you're paying and you are reimbursing them because they purchased home office equipment, or you're giving them money to buy that equipment to work for you, those are also considered taxable wages. Last thing I'm going to cover for you guys is 1099s. 1099s we see a lot, and so these are services that you pay for that are provided to you by a non-staff or non-employee person. This is when you contract something out, like somebody is, an engineer, an architect, and you need services, a blueprint, something that needs to get built, a welder, all of these we've seen. If they are providing you with a service, then a 1099 must be issued if your total payments for that calendar year add up to $600 or more. And so those include fees, right? So like an advertising fee gets a 1099, commissions for someone that you paid for. If they came and made a cool drawing on your window for the holidays, those get 1099. And those get 1099 as a non-employee compensation. So that's what it stands for. NEC is a non-employee compensation. And that's for most vendors who provide services to you. The other one we've seen is that is most common is a 1099 miscellaneous. And these are issued to renters. Any payments you may have made to an attorney, maybe for a copyright or anything like that, any payments made to an attorney need to be disclosed on a 1099 miscellaneous. If there were any royalties that you made in exchange for a dividend, if you had an investor, all of these of $600 or more need to be paid out. And the last thing I want to point out is these are issued to vendors who are not incorporated. So a lot of times you have a janitorial service who comes and cleans your building and they are an LLC, they need to receive a 1099, with the exception of attorneys. All attorneys need to receive a 1099 miscellaneous. And so with that, I've covered kind of a brief summary of the few things that we need to look at for the end of the year as you start to close the year. And I'm going to hand it over to Tori to cover the tax portion of this.
All right, here we go. Before I get into the tax strategies, I do want to make a differential here. A lot of the times, if you guys are having financial statements either compiled or reviewed, audited, etc., they are in what's called accrual basis. So accrual basis is you recognize the income when it's earned. So when you actually do the job and it's completed, or you ship the materials out or whatever. It's same with expenses when they're incurred, when you actually use them. On the flip side of that, we have cash basis, which is fundamentally a little easier to understand because you just follow the cash. So income is recognized when you actually receive money, and then expenses are recognized when it's paid. So why is this important? Because you pay cash or you pay tax on your bottom line. So usually you want the lowest income possible for the IRS, so that way you pay less tax. Majority of small businesses are cash basis for this reason. And IRS considers under 29 million in sales, which I've heard that you guys might not be there, considering you aren't selling anything right now. So majority of the time you will be cash basis. Right. So moving on to depreciation, like Selena mentioned earlier, these are large items that you are going to use over multiple years. So instead of expensing them right away, you are going to what we call capitalize and depreciate. So for 23, the accelerated bonus depreciation is going down to 80% immediate deduction on large assets that are placed into service. So this does not include buildings, and then certain cars have special rules. But for the most part, other than that, you have an 80% automatic deduction. It was 100% last year, and it's moving down 20% each year until it just goes to a standard. Now, that's how the rules are right now. Could they change? Absolutely. But to put this into numbers, let's say in December of 23, you go and buy a piece of equipment. So your depreciation expense on your tax return at least would be $80,000, and then you would depreciate the remaining amount over 5 to 7 years, depending on the equipment. Now, let's say instead of December, you hold off and you say, you know what, I'm not going to buy it right now. I'm going to wait until January to buy the same equipment. Then your depreciation expense would only be $60,000, but you would still depreciate the remaining 40 over the useful life. So at the end of the life, it's the same amount. You still get to deduct the 100,000. However, just by that month, you can either deduct $20,000 more or not. So depending on where you're standing, there's a lot of other things. Do you have the cash flow to buy the equipment, et cetera, et cetera? There's a lot of other factors you need to consider when buying equipment. However, if you do buy it sooner in 23, you will get a higher deduction immediately. All right, now for the more complex topic is the R&D credit. Not much has changed since last year, but just to go over it for those who weren't here, it must be a new and improved function, performance, quality of a product, and it eliminates uncertainty. So all qualified research expenses. So what does that mean? That basically means it comes in 4 buckets. So you have compensation to employees for qualified services, which is actually who goes into, is actually developing this, right? Who's working on it. Then 100% of supplies you use in your research, 65% of any research to a third party. So you hire a contractor, you bring them in, and then 75% would qualify, or 75% if you paid an educational institution for these payments. So after you have your buckets, you set your limits based off the percentages, and you have your qualified research expenses. As far as the credit goes, it's calculated by 20% of these QREs above the base amount. Now, this base amount is not an easy number to come by, unfortunately, but luckily for startup companies, it is 50% of total QREs. Another nice little thing to mention is if you don't have income tax, then you can apply this credit against payroll taxes, which is actually quite nice because I think this is the only credit I know of that you can do that. So, now in 2022, we saw a huge change to the R&D credit. So last slide was credit. Now we're going to talk about the deduction and expenses associated with the actual research and development costs. Pre-22, everything was directly expensed, nice and easy. However, this year including, as of right now, all research and experimental expenses will be capitalized and amortized over 5 years if they were to a US company, or 15 years if it was outside of the US. So notice how it says research and experimental expenses, not QREs. That is because the IRS just recently, I mean within the last month, gave us a little bit of description of what this means. They are basically the same thing. However, there are a couple of little differences to them. Why, you're probably like, why do I care about something that happened now 2 years ago? And it's because currently Congress does have a couple of bills moving through that will restore to the pre-22 guidelines where you would directly expense, which means lowering your income all in 1 year instead of over 5 or 15. So, however, there's no concrete timeline as to when this change will take effect and if it even will. But it's something to at least consider. So numbers again, because numbers help things make sense in my head. Let's say your income was $1 million and it's 2021. And your R&D expense, which you're going to expense the entire thing, is 2 million. You have a loss of 1 million. Your federal tax is 0. And then you have this large credit of 200,000 that can be applied to your payroll taxes. Okay, this is for C Corps who actually pay federal tax, right? So now moving on, it's 2023. We have the same situation. You have the 1 million in income. Now your R&D amortization, so you're going to take that R&D expense and either amortize it over 5 years or 15 years. And in this case, we calculated it, it's 200. Net income 800, your federal taxes 168,000, your credit is only, or your credit remains the 200,000, and you have a slight overpayment. Now, notice the difference in the amount of taxes paid from before 22 and after 22. You went from 0 taxes owed to 168,000. So it is a big change, but hopefully it looks like it might be restored to direct expensing, but that has not been official yet. Now, for pass-through entities, these are our S corps and partnerships. It's pretty similar, especially the 2022 column is exactly the same. And the pre-22, after 22, you'll see that there is a QBI deduction, which will also go against your taxable income. I will explain QBI in just a minute. But as you can see, your federal tax would be $296,000 instead of 0. So it is quite a big difference. All right. So moving on to this qualified business income deduction. This is for pass-through entities. So S Corp and partnerships. They're allowed an additional 20% deduction on the personal return for any QBI income. There are limits depending on your filing status, and these are adjusted every year for inflation. If your income is above the limits, it will be limited to either 50% of your wages or 25% of your wages and 2.5% of your qualified business asset investment. What does that mean? It's basically your capitalized assets over I think within the last 10 years. Typically 50% of wages is the higher number. So that's what I'll go through in my examples. Let's say you have $1 million income again. So you would get a $200,000 deduction. Your taxable income would be $800,000. This is if there was no limitations. So the income limitation went away, basically. It's very simple, exactly 20%, you move on. However, there are such things as income limitations, and so $1 million would be way above the single and the married. And so it is limited. If you go to the right, you would see you have wages of 200,000, which means 50% of that's 100. Then you would compare 20% of your net income is 200,000. 50% of your wages is 100. So which one's lower? It's gonna be your wages. And then your taxable income would be 900,000 instead of the 800. All right. So, pass-through entity tax. This is for almost all states have some sort of pass-through entity tax. I'm going to go over Arizona because that's the one that I know the best. They are all practically the same, just they all operate in the same way. You might have to look at your own state for specifics, but basically you get to deduct state taxes paid on your federal return while receiving a credit for state taxes paid. Explain that a little further. It is you're lowering your federal income, which is always a good thing because you're going to pay less tax. And then whatever money you give to the state, you're actually going to receive it back as a credit. So that's a dollar for dollar tax savings for the amount that you paid. So it is available to partnerships and S corps with Arizona income tax liability of over $500,000. You take your income tax, and it's a flat 2.5%. The 2.5% is for 2023. I think previously it was 3.5 or 3. So, however, you must notify the partnership and or S corps, individual, state, trusts, partners, and shareholders, who then have 60 days to opt out or not. And this can be if you are, it's just you and your one-man band and your S corp, then you can be like, yes, I want to do this, and you do not obviously have to wait the 60 days. You just have to give everyone outside enough time to go, what is this? Do we want to take part in it? I will say the pass-through entities with taxable income exceeding $150,000 for the prior year, so for 22, are required to make quarterly estimated tax payments and may be subject to penalties. So these are the same penalties with the personal underpayment penalties, just like you would on your personal return. Now, this payment, in order to get this deduction this year for 23, the payment has to be made by the year end. If you make it in, let's say you make it in April when your taxes are due for your personal return, you won't see that benefit until the next tax year. So it's important to get those in. It is pretty easy. You go to arizonataxes.gov and follow the prompts. So they have made that quite a bit easier. That's all I have to say. Thank you so much for having us.